The public infrastructure investments, they tend to be a little bit more mature. So as a result, we're not talking about things that are at the startup level. The cash flows tend to be more stable.
The infrastructure today is where a lot of mindset is going. So that's a good part, right? So that's the good side of things.
That's Bill DeRoche, Chief Investment Officer with AGF Investments, here on behalf of AGFiQ, AGF's quantitative investment platform, who is sponsoring this program. Thanks, Bill. And Rick Cross, co-founder of Wright Financial Advisor, registered investment advisor with American Portfolios.
I'm Mike Venuto. Welcome to episode 103 of the Think Tank Exchange podcast. We're talking about investing in infrastructure.
I'm David Chikansky. Thanks for joining. Hello, Venuto.
David, good to be here.
Infrastructure is a very timely topic right now with inflation concerns at the top of many people's minds. My colleague, Michael Gayad, leads off the ETF Think Tank Live discussion.
You hear the term infrastructure thrown around a lot in the media, but it's a pretty kind of, I think, a amorphous term for a lot of typical investors. How do you define infrastructure? Let's kind of go very kind of simple and top down first. How do you think about infrastructure? What falls into the category of infrastructure in general?
Yeah, so Mike, when we think about infrastructure, we're thinking about real assets. They are different than, say, pure real estate in that these real assets tend to facilitate economic activity. So we're talking about things like energy infrastructure, transportation infrastructure, more recently, digital infrastructure. So again, two elements. First being having a real asset component, and second, having an ability to facilitate economic activity.
Interesting. Good point, Bill. So when I think about infrastructure, I'm thinking sometimes about water and energy. I'm thinking about 5G. What are your favorite areas, and how are you pursuing like the tilt around active?
Yeah, so when we look at infrastructure, historically, it's been an area where initially large asset owners would take direct investments into larger projects, which would allow some of the risks to be alleviated from, say, some of the public folks that were working on projects. More recently, even at AGF, we've had a number of private funds, both on the equity side as well as on the debt side, where investors could directly invest in a fund and have access to infrastructure. Obviously, those types of private funds come with issues with regards to you need to be accredited, there are capital calls, your money's locked up for a significant amount of time. So one of the things that we've seen more recently is providing investors access to infrastructure through public listings. There are a number of global listings around the world that investors could invest in and provide themselves with a diversified portfolio of infrastructure investments. I will say that we see more of these public listings globally than, say, in either, just in North America. So in addition to providing that diversification towards real assets, it also provides diversification through a more global portfolio.
And Rick, I want to bring you in on this as somebody who's managing discretionary assets and does asset allocation. You mentioned Bill on the global side. I want to pick your brain, Rick, a little bit on, when you think about going forward, do you think we're in an environment where finally you're going to see some movement outside of U.S. markets into global themes, and is infrastructure one of the key areas that you think might have a lot of potential here?
Oh, absolutely. So we know we're a global economy. Transportation, the global infrastructure is a theme that I've been appreciating and incorporating with my clients for quite some time. Today, where we are right now, I use this line: this is not your grandfather's infrastructure. It encompasses so many different aspects, but it is not just a domestic, it is certainly a global side of things. And one of the things I was thinking about was, so many people around the world rely on, say, for instance, a product delivered overnight, right? That Prime, you press a button on your phone and 2 days later products show up. And they're using a whole series of global infrastructure techniques to get those products to our front door every day. And it's around the world. So yes, I am thinking globally.
All right, David. So this whole first section was really about defining what infrastructure investing is. And it seems to me what Bill is telling us and what Rick seems to want to buy is not your grandparents' infrastructure.
Precisely. This is the type of infrastructure that's facilitating all things cloud-based, not necessarily your roads and tunnels and pipelines that you're accustomed to.
Yeah, so it seems like all these mega trends we've been talking about this year that have been accelerated in response to the COVID economy that we like to call it, this is the kind of infrastructure that they're seeking, right? The cell towers, the things that support 5G or blockchain. So it's a really interesting take on infrastructure today.
Let's pick this conversation up with a question to Bill DeRoche about why infrastructure matters now.
Bill, one of the most important questions I hear whenever talking about investment themes or strategies is why now? What is it about infrastructure? Because listen, let's face it, we've heard about infrastructure spending for what seems like years at this pace. Not just here in the United States, but I think also globally. But is COVID the catalyst just to get people back to work, and that creates an impetus for governments to want to spend to finally repair some of the structure? What's the catalyst here from what you're seeing?
Yeah, so I think it has to, a number of things have to come into alignment for the category to really take off. I think some of the points that have been made in that we're at an inflection point where there is a need now for a significant amount of more infrastructure. I think spending. I think more importantly is there's a lot of new areas that are really picking up that folks really are focusing on. Think of digital infrastructure. So we have all the cloud stuff that needs to be invested in, 5G technology, as well as satellites. In addition to that, we have all the renewable energy investing. So there is going to be a lot of opportunities. Some of those areas are growth areas. But I also think some of it comes back to the investor in general. If we look at the investing landscape, if you look at your core equity portfolio, there's a significant amount of intangibles that are in equities now. So the ability to access some of these more real assets is something that I think people are going to be interested in. So when you look historically at these infrastructure public assets, they tend to have lower betas. So you're going to end up with something that has a little bit less volatility, and they tend to have higher yields. So to Rick's point, the fact that fixed income is at such low yields, you can access something that acts as a bridge, say, between fixed income and more traditional equities. So given that, the attractiveness from an investment standpoint, plus the fact that there's going to be growth in the space, we think it's something that everybody should, look at. And we could provide some suggestions as how it can fit into your overall portfolio.
And Rick, so when I think about, the infrastructure play, and I think about how to edge into the international allocation, this is the way, this is where I see opportunity set for infrastructure. It's a global allocation. We need, internationally and in Europe, you need it. That's how I find financial advisors using it.
Well, I think it's an asset class that people they can understand and grasp and get their arms around to a great extent. So when we're dealing with clients and having them have an appreciation for that global diversification that everybody needs in their portfolio, when you zero in on one aspect or a specific aspect, infrastructure, I think it's the average consumer that understands, bridges, tunnels, other things. And as Bill said, the internet captures the attention of my clients. And so it's a long-term strategy. This is not a short-term thing, but it's going to be going on for years. And I think everyone is pretty much on board with the concept of something along infrastructure being on a global basis, not just a domestic.
So Guy had really hit on the why now infrastructure, but there's also a question of where should the infrastructure investing be? Meaning, is it just US or is it global?
The infrastructure need could definitely be argued to be much more necessary in the international space today than in the US, just because of the size of the economic base and the number of participants in the economy.
Yeah, and if you're going to be the infrastructure that supports themes, well, we all know themes are global. We define them as such at the ETF think tank, right? This mega trends, if you're going to support them, you got to be global today.
These companies and their services don't really care where their company tends to be domiciled. That is not really important to the end consumer. And their reach is often to almost every country across the globe.
Yep. Emerging, international, US, Canada, Timbuktu. The themes are happening. The infrastructure is necessary.
As we get back to the conversation with Michael Gayed, he'll steer us towards a different angle, talking about why infrastructure is not just a theme, but a catalyst. Rick, Dan, and Bill have more to say on the topic.
When you think about infrastructure, it's not just a theme, it's a catalyst for other themes too. How do you think infrastructure might play out in terms of even things like monetary policy, things like inflation, things like the bond portion of a portfolio? Because we talk about yield, you don't get a yield in bonds, in the traditional way. Now you kind of have to go a little bit further out in more esoteric parts. Infrastructure is a yield play and may actually force bonds to have higher yields too.
Well, a couple of points on that. The first is that with COVID-19, the global pandemic, right, we need to reignite the economies around the world. And building infrastructure is tapping into a lot of those people that are being repurposed. They cannot find jobs that they were originally intended to go to. Second, the greater the build out of infrastructure, the greater demand, as you said, for steel commodities, which would probably lift inflation, which the Fed would love to have right now. So yeah, down the road, I certainly see interest rates rising as we get out of this with vaccines out there. But, one of the things that I was thinking about was, what we did with the vaccine, right? The warp speed. If we could do with the infrastructure what the United States and the global world did with coming out with vaccines on a warp speed kind of mindset, certainly that would benefit not only the companies, but would put pressure on yields. And so two things. One is as bonds go down, as yields go up, having that sleeve of income coming in from this alt bucket is probably a desirable thing.
So it sounds to me, Rick, and actually this question is for Bill. Infrastructure is aligned with inflation, meaning that more people potentially who are employed and commodity prices going up, and with that comes more spending on infrastructure, and it becomes a cyclical thing, right? Because we need more people, and this is a global problem. We need more people employed, right? So the central banks are going to really push forward on plans. Where are you looking for the catalysts? Are you just reading central bank materials? Are you reading industry materials? Because you're an active manager here. Help me out on that.
Yeah, so when we look at the category itself, we talked about the investment thesis in terms of how it can sit between a fixed income and equity portfolio. When we look at the catalyst for growth in this particular area, there's an element of obviously public policy that we need to investigate in terms of, where are the government dollars going. From our perspective, every year there tends to be more and more consideration around, more public infrastructure spending. But I still think that it's the driver will be the public sector. And most of that will come from areas where people think that there'll be growth and there'll be economic activity and an opportunity. So from us, from our perspective, we're focused a lot on that digital infrastructure that we were discussing, as well as the renewable energy sustainable area. We think those are growth areas that not only will you have access to real assets, but you're going to have access to good capital appreciation as well. So that's the focus for us, as well as the investment thesis.
So Guy had really teed it up here with this yield drought, right? We keep coming back to, is there more risk in bonds, and could infrastructure be a replacement for yield in a portfolio?
We do think that the yield is obviously fantastic and can replace the income from fixed income, but we don't bucket it in a fixed income category and look at it more as an inflation or an alternative to traditional asset allocation.
Yeah, I think it's hard to take equities and assign fixed income characteristics. No doubt these have yield, but these are also the kinds of companies that would be used in a risk parity strategy to, capture the inflation benefits of infrastructure companies.
Precisely. This should actually have more correlation benefits to fixed income than traditional equities do.
Yes, and I want to thank AGF for sponsoring this program, and thanks to you specifically, Bill.
Yeah. So as we move on, we asked Rick, how do you think about active versus passive in the infrastructure thematic space?
So I think my first thought process is that the infrastructure today is where a lot of mindset is going. So that's a good part, right? So that's the good side of things. It's the active. I'm a long-term investor. I always have been. I always try to get my clients there. And so I think that where we are in 2021 and the build out, this is a long-term sustainable play. And just to circle back on something we were talking about with the Fed, I think if they do a really robust infrastructure program, maybe public-private, we can use some of those funds, both from the public and the private, to really jumpstart the economy and really create that velocity of money that will get us out of the hole that COVID has created. So I just see sustainable, and it evolves too. So infrastructure is evolving, as we talked about with satellites, with renewable energies, and so I think it's a great asset class to consider.
That was a great point, Rick. I'm glad you brought up renewables. Bill, what does ESG and renewables mean to you when you're constructing a portfolio?
Yeah. So, what we've seen, say, over the last 24 months is that ESG investing has really come to the forefront. It's been discussed, for over, say, a decade or more. But the money really hadn't flowed to the space. It's moved there significantly. If you look at some of the index providers, MSCI is a good example. Their fastest growing areas have been in ESG investing. One of those areas is the whole sustainability area. So in addition to just ESG, which focuses on, say, governance and social issues, there's the whole environmental side, which you could just create portfolios in and of itself with regards to sustainability, which has really become, a very important cornerstone to what a lot of people are doing. There's been, quite a few, call it UN PRI type stuff, where folks are trying to make sure that their portfolios meet certain criteria for sustainability. So we're seeing a huge, move towards that. Just take the energy area. I mean, if you look at some of the more traditional energy companies, which if you just ignored what they do with their profits, you would think that, they're older and really not moving towards the renewable. But a lot of them are really investing most of what they're doing into this new area of sustainability and renewables. So I think it's a positive for the world in general. And, we're moving towards that model where economic activity can be more sustainable in the future.
So, Bill, how do you look at the world from a global standpoint with infrastructure?
I think Rick made the point earlier that a lot of the growth is coming outside of the U.S. Those areas definitely need a fair amount of investment. A lot of what we see overseas early on is more public-private type ventures. As we mentioned, a lot of the public type infrastructure products tend to be more mature. So we try to balance that. As I said, I think that Dow Jones Brookfield Infrastructure Index is a pretty good place to start. It is global. And when you look at it, you get a pretty fair diversification, not only from a regional perspective. It has both developed markets as well as emerging market projects in there, as well as a pretty good spread across those sectors that I mentioned. From our perspective, the one area that we look to add to is the more newer area, which is that digital infrastructure as well as renewable.
So this was really interesting because we got into ESG, we got into active versus passive, we got into Tesla. I saw questions in the chat about how do I invest in charging stations? But to me, it seems very obvious that something that's going to support megatrends needs to be active.
It's really hard to quantify what is ESG and what is not. Some of the largest budgets spent on research and development in the ESG space are done so actually by oil companies. BP plans on being the largest provider of natural energy by 2040. So at what point between today and then do they become a major holding in your ESG portfolio?
Yeah, this has been a recurring theme on our shows. We had an amazing debate with Burton Malkiel on the concept of what should and should not be ESG, especially in this infrastructure space. Additionally, at etfthinktank.com, we have a lot of this research available. This past week, we wrote about these themes and how clean energy, especially clean energy infrastructure, is some of the best performing assets of the year, like literally triple-digit returns.
Lastly, we look at theme from a 10,000-foot view from a cyclical level. Guy had asked,
are we going to see a commodity super cycle version 2.0? Right, so we saw the commodity super cycle driven by China really from the 2000s, and could infrastructure spark a global super cycle again in commodities? And the 2.0 is kind of alluding to the idea of digital infrastructure as a part of that. And it's interesting, right? Because COVID may be the start of that, in the sense that the commodity which has really gotten the most traction has been lumber. Lumber because of the link to housing, as people have moved away from some of these steel-centered cities into more suburban lodge-based homes. And that may be just the start of, I think, a broader cycle, which is why I keep going back to this idea that the Fed may get its wish, not through their own doing so much, but rather through cost push inflationary from the commodity side, kind of helping them out. And when, I've talked about this before in a lot of the research I put out, when you look at the ratio of equities to commodities, I mean, if you wouldn't buy here, I don't know when you would, in terms of the idea of a thematic rotation, right, into commodities. And infrastructure is, I think, kind of a big part of that. So it'll be very interesting. The thing about cycle changes is that you only know if you're in a new cycle 2 to 3 years after you're already in it. So we may already be in this potential infrastructure commodity driven super cycle. And I'd be curious, Bill, to kind of hear your thoughts on that. Let's say that the infrastructure theme, becomes more than a theme and is a longer term secular trend, because there's so much that needs to be done there. How long does it last?
Oh, that's a great question, Mike. I think from our perspective, it's always been there, and our view is that it will continue to be there. In terms of having a super cycle, I think, we've always predicted that. Every president in the U.S. has talked about a big infrastructure spend. We continue to still wait for it. So I think, hoping for this huge wave that, goes on for, decades, I think that's somewhat unrealistic. It tends to be more fits and drabs. But I think the money flows towards the areas where people can see good economic opportunities. So again, we keep coming back to the whole digital area. I think that's going to be an area that's very capital. There'll be a lot of capital going there, as well as this sustainable area. And from our perspective, we do like some of the more mature areas because they tend to have lower volatility and more stable cash flows. But I'd say that just looking at the space, from our perspective, for it to continue to deliver what we expect from it, which is, steady cash flows, lower volatility, some diversification through access to global, and that's both domestic, developed as well as emerging market. We don't need this huge, super cycle in terms of infrastructure spend. So the characteristics are already there, and those characteristics make us excited.
Every Think Tank Exchange show, we ask our advisor guests to highlight a charity that particularly resonates with them.
So, Rick, we want to have you emphasize a charity. What's the charity that you want to emphasize for audience members to consider donating to here?
Sure. My charity that I've done work with in the past and will in the future is Make-A-Wish Foundation. I think everybody knows what that means. It's helping children who are sick, and that really tears at our heartstrings. They definitely need assets and donations, but it's the work that they do and how they help people. And that's how I viewed my success in my industry is I go out there every day and try to help my client base, and I like to give something back. So thank you for this opportunity, by the way.
Thank you for being here. Well, I thank everybody, including the guests, for being here in the Think Tank Exchange. Be healthy and be safe.
Thank you, guys. Stay safe.
Thank you all. See you next time.
Bye-bye.
Happy holidays.
Happy holidays.
As we wrap up this episode, we'd like to thank AGFiQ's quantitative investment platform for sponsoring this program. Remember to join our ETF Think Tank live exchange by following ETF Think Tank on Twitter, LinkedIn, and at etfthinktank.com. Your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
That's because our value proposition is to enhance yours. I'm Michael Venuto.
And I'm David Jacansky. Until next time, stay classy, sassy.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.